Welcome, everyone. In this explainer, we're going to take a close look at a financial model called market DNA. Think of this as a documentary-style case study. We'll be tracking exactly how this geometric model was applied to the NASDAQ 100 index. Let's dive right in. So, here's what we've got on tap. First, we'll introduce the analysis itself. Then, we'll break down Phase 1, which is all about the strategic plan. After that, we'll document the market's reaction during the N-level event. That's Phase 3. And finally, we'll cover the cycle's current status and, of course, run through some important disclaimers.
Okay, so our focus today is on one very specific cycle on the NASDAQ 100. In the public documentation, this one is identified as cycle ID US100_2_3. Just to be clear, we are simply documenting the process exactly as it's been recorded.
So, what's the goal here? Well, it's pretty straightforward. We're just going to narrate the observable events of this market DNA cycle, from the initial planned entry all the way to a partial exit. Everything you're about to see is based strictly on the provided data and charts. We're not here to interpret anything, we're just observing what happened. All right, let's get into the good stuff. Phase 1, the strategic plan. This is basically the blueprint for the entire cycle. It was all laid out on January 18, 2026, and it defines everything: the entry, the risk, and all the potential targets. So here it is, the initial setup. This chart shows you the model's geometric structure laid right over the NASDAQ 100. You can see the price right at the primary entry point, which is labeled level M. And you can also spot those predefined shapes we'll be talking about: triangle 3 and the trapezoid. Now, the plan itself actually had a two-tiered entry strategy. The main, or primary entry, was set right at level M. That's 25,203.7. But there was also a secondary, optional entry point defined at PC, which is 24,880.4. That second level is a key part of the model's approach to risk management. Every plan needs a solid foundation, and this slide shows you exactly that: the risk parameters. As you can see, they are very clearly defined. The plan starts with a hypothetical capital of $100,000, and it sets a maximum allowed drawdown of 5%, which comes out to $5,000. The model also specifies other key inputs, like a 36-day trapezoid time duration, a third triangle domain, and a risk coefficient of 2. Now, how positions are sized is incredibly specific in this model. In fact, the documentation puts it this way, and I'm quoting directly: both trait sizes are calculated using the hypothetical capital, the investor's maximum allowed drawdown, the third triangle domain percentage, the risk coefficient, and the contract size. So as you can tell, this really highlights the systematic, totally rules-based approach. And here's what that calculation spits out. The total position size for this cycle is 0.32. That's then split right down the middle, with each of those two potential trades having a size of 0.16. From this starting point, the plan laid out two possible paths the market could take. Scenario 1 was simple. The price just moves up directly from that first entry at level M. But in Scenario 2, the price would actually dip down first to hit that secondary entry level, PC, before it started to move up. Okay, let's crunch the numbers for Scenario 1. If the price moved up from level M and went all the way to the final target, T3, at $25,923, while the expected profit was calculated at $1,151. Based on the plan's time frame, that works out to an 11.66% annualized return. But what about Scenario 2, where both entries get triggered? Well, the first position from level M still aims for that same final exit, for a profit of $1,151. But the second position from P has an earlier target, T2, for a profit of $1,153. You add those together, and the total expected profit jumps to $2,304. That represents a potential annualized return of over 23%. Okay, so now we get to shift from planning to what actually happened. This next part is all about documenting what the model calls the N-level event, and this all went down on January 22nd. So take a look at the chart from January 22nd. As you can see pretty clearly, the market did not go straight up. The price action first dipped down and tagged that PC level, and then it did a 180, reversed course, and climbed all the way up to the level marked N. So let's just quickly recap that sequence of events. Step 1, the price went down and hit the secondary entry point at PC. Step 2, that event immediately triggered Scenario 2 from our strategic plan. Step 3, right after that, the price reversed and rallied up to the apex end price level, which was 25,601. So what's the significance of this N level?
Well, according to the model's rules for scenario 2, this level is what's called a safe exit. So the position that was opened at that secondary level, PC, was closed right here for a profit. Meanwhile, the initial position from level M, that one stays open, continuing along the cycle's path.
And this action had a very specific, concrete result. That secondary trade from PC up to the end-level exit locked in a realized profit of $1,153. And what's really interesting is that this amount perfectly matches the expected profit that was calculated for this exact move way back in phase 1. Okay, so that brings us right up to the present, the current status of this cycle. Let's take a quick look at where things stand as of now, and what phases are still pending according to the model's structure. So, as of the documentation date, January 22nd, the cycle is officially in phase 3. The journey isn't over yet, the path is still unfolding. This timeline really gives a great bird's eye view of the whole cycle. The documented path for this particular cycle is 1, then 3, then 2, and finally 4. We've seen that phase 1, the plan, is complete. We are currently in phase 3, the end-level event. So still ahead of us are phase 2, which is called mirror contact, and then phase 4, the grand finale, which is the trapezoid. All right, before we wrap this up, we have to go through some very important disclaimers, so please listen carefully to these next few points. First and foremost, this is not financial advice. Leverage above 10 is prohibited. Do not invest essential personal funds. This analysis is provided for public model documentation and verification purposes only. And finally, any risk management must strictly follow the user's own instructions. If you'd like to follow this case study yourself, or if you just want more information on the public model documentation, you can visit the website you see right here on the screen. So, we've seen a plan, and we've watched its partial execution unfold based on the public record. It really leaves us with a fascinating question, doesn't it? As this cycle continues to play out, what will its completion ultimately reveal about this very unique geometric framework? Something to think about. Thanks for watching.